Hello everyone, my name is Christos Mastoras of Iliad Partners. I'm very happy to be here today, kicking off Innovation Week in Dubai and UAE, and speaking on a topic which hopefully will be interesting and relevant to entrepreneurs and startups in the community. So thank you very much for having me today, and thanks for your time. Before we get started, I just want to tell you a little bit about myself so you get a little bit of context. This is a lot of information, but basically my background, I'm currently a founder and managing partner of Iliad Partners, which is a new venture capital firm based in Dubai focusing on early stage tech investments. This is fairly recent development. Before that, I was running business development and partnerships for Yahoo Maktub, running partnerships in the MENA region. And before that, I was a management consultant with Booz & Company, again based out of Dubai, working in the telecom, technology and media spaces. During this time, I've also been very much involved in multiple startups as an entrepreneur, as a founder, as an angel investor. One of these startups is called Glambox, which you may know about. It's an e-commerce startup focusing on the beauty industry and women based in Dubai. And before that, I was a member of a number of startups, including Upstream, a Greek mobile advertising startup based out of Greece, and earlier GovWorks.com, a New York-based internet startup earlier during the boom and bust years of 2000. And in this time, I'm also I want to be very active in the ecosystem as a mentor and judge, whether that's with MIT Enterprise Forum, ArabNet, Flat 6 Labs, WAMDA, and other organizations. Also, to tell you just a very few quick words about what is Iliad, so you kind of get a little bit of a sense of where I'm coming from when I'm talking about the topic. So Iliad Partners is a new early stage tech VC based in Dubai. We're newly formed. We aim to fill the gap between large VCs on one hand and then smaller incubators, accelerators, angel investors in the MENA region. We believe there's quite a big gap there, and I'll speak to that in a bit. We target investments in early stage startups in tech, Series A, as well as late seed and Series B. We focus on tech and digital exclusively in the MENA region, and our typical ticket size is between $500K and $2 million. The investment scope, on the MENA region, and the ticket sizes of our investments are between $500,000 and $2 million. And I was going to talk about now the investment scope, actually. So we like to invest in spaces which we know well, and in areas we see gaps, such as internet services, digital media, mobile apps, e-commerce enablement, fintech, software as a service, analytics, both in B2C and B2B. These are some of the spaces we like. Our model is to be actively involved. So you have VCs which are much bigger and invest a lot of money across many different startups. We want to do 2, 3, maybe maximum 4 investments per year, be quite involved to help through our value-add expertise and global and regional networks, and do what we can to help each startup grow and scale across the MENA region. At the same time, we also have a quite expansive global network. We have good links into Silicon Valley, MIT, and other global markets. So just indicatively, in terms of our advisors, partners, and co-investors, we have partners across 13 countries and 19 cities. And for us, this outward-looking approach is very important. We want to be very linked and connected with the outside world, outside of MENA, but also be a bridge into the MENA region. And just a very quick profile, so you kind of get a sense of who we are. And this is sort of like the 5 key points which we like to identify with. Number 1, we're entrepreneurs investing in entrepreneurs. You may have seen other VCs and that have maybe other backgrounds. The way we want to position ourselves is we're entrepreneurs. We've done this before. We believe that entrepreneurs understand the needs of startups better than others. So having done this, we're in a good position to do that. We're also digital media experts. If you look at the wider team, we have people who've been with Yahoo and NBC and Microsoft, Skype, Facebook, and LinkedIn. So this is our deep domain expertise. We're also veterans of the MENA region. So we've been around for, most of us, over 8, 9, 10 years in Dubai or the wider region. So we also know this part of the world very, very well. And as I mentioned before, we're also globally connected. And the last thing, last but definitely not least, in terms of our mentality, we want and are collaborative. We take pride in rolling up our sleeves, working side by side with founders and entrepreneurs. We want to, we are very rigorous with our investments, but we also want to be collaborative and humble. And we want to, we don't sit above the entrepreneur, we sit side by side and work together. And that's really sort of the ethos we want to bring to the industry. So enough about Iliad, but if you want to check out more, go to iliad-partners.com, and we'll kind of get into the main topic of discussion, which is, of course, how to do a pitch. This is the agenda. So I'm going to do a very quick intro talking to you about our very brief view on the industry itself and why it's important to do a good pitch to investors. And from there on, kind of go into the mechanics of how we would recommend, if you're doing a pitch, how to do it. There's no wrong or right answer. This is what we've learned over the years. So, first of all, as you probably know and also believe as well, the MENA tech startup landscape is developing very rapidly. You have a growing entrepreneurial ecosystem with a number of organizations flourishing. You have an expanding universe of startups, so many more startups than we had maybe 2 or 3 years ago. You also have more funding activity, so more investors, VCs and otherwise, investing in these startups. And at the same time, you also have a number of increasing exit opportunities. Back in the day, the only real notable one was Yahoo acquiring Maktub, but of course, in the meantime, you have Talabat and a bunch of other exits. So if you look at this landscape in a nutshell, you really see a landscape, a startup landscape, and a VC landscape that's flourishing, which is great news for everyone. That said, there are quite a bit of gaps still because it's a new ecosystem and it's definitely not perfect. And having raised myself funding from VCs, I can tell you it's not a perfect process. And I can sort of really quickly highlight some of the gaps and challenges if you're a startup or an entrepreneur trying to raise money. So up until recently, you actually had quite a bit of a lack of VC funding. And there's different ways to look at this. You can look at the sheer number of money available, but also you can look at sort of this quote-unquote smart money, meaning, okay, you're raising money, but who are you raising money from? Can this person or institution actually help you? Or are you just going to get the money and try to figure it out on your own? Also, until very recently, there were gaps in larger investment sizes. So anything above like 2 or 3 million, good luck trying to raise. That slowly is changing, which is a good thing, but still, it still continues to be a bit of a gap. The most pronounced gap, in my view, is this thing I call the missing middle. So on the earlier stage, smaller tickets, you have angel investors and accelerators and incubators, which invest anywhere between 20, 30K to 100. And on the other hand, you have these big VCs who invest 2, 3, 4, 5 plus million. But what happens in the middle? And that's actually the hardest part. It's the part when you're still validating your product, you're starting to get some revenues. No one seems to be wanting to take that risk in that sort of, some people even call it the valley of death. I avoid calling it that because it's not a very happy term. But it is a gap. It's a very pronounced gap. And it's what people call risk capital. And there needs to be more of that. And that's the space we, Iliad, operate. And then from there on, there's also lack when it comes to follow-on funding. Okay, so if you raised some seed money, you've raised Series A and B, then what? What happens then? So I remember when we were raising for Glambox, we had done a seed round from our own pockets, then we raised a Series A, and then, the VCs at the time, about 2 years ago, actually did not have the capacity to invest 2 or more million. So we actually had to resort to talking to family offices in Saudi and other GCC places. And we did raise the money, but it's not, you know, your typical VC money. It's not your typical sort of place you would go. Now, that's sort of on the money side. On the right-hand side, you have an even more pronounced gap, in my view, with no offense to, you know, any of the current investors. But speaking to entrepreneurs in the space, having experienced it on my own as well, there isn't the help that you would really expect. Whether it's, you know, okay, you validated your product in Dubai and UAE, and you want to enter the Saudi market. You know, can you help me get into the Saudi market? Can you help me get onto big media such as NBC or, you know, some of the other digital plays? These things are important. So just getting the money is not everything. There is a gap there, and I think a lot of investors are putting more effort to try to bring the par up to what, you know, things are in Silicon Valley and other places. But still, I think there's a gap there. Access to global expertise and capability. So even in terms of the investors that are here, we tend to look inward, and the idea is how do we create these bridges with Silicon Valley? How do we create these you know, bridges with other markets, growth markets, or centers of excellence such as MIT or other places? So I think this is very important, and this is not necessarily an immediate benefit. It's a benefit of how do we get access to the best knowledge there is, or, you know, expertise, or thought leadership. You know, what's big in 5 years? What's not what is big yesterday, right? So having this access to this knowledge is in my view, very, very important. Also in terms of when it comes to talent, one of the key roles of a VC is to help recruit. And that's not always easy, because either you have talent that's scarce, or you have talent that's too expensive, or you have talent that doesn't exist in the region. So, you know, there, in my view, investors must take an active role and find people across different geographies. So, like, if a startup is based in Dubai, try to bring people from places that have very good, you know, engineering or commercial talent, such as Lebanon, Jordan, Egypt, just as an example, or even outside the region. Bring people from Europe, Asia, US, what have you. And the last thing, of course, is, you know, ability to facilitate exits. Here, it's been a bit anecdotal. So there's been investments, and then there's sort of this sort of anecdotal hope that one day somehow some international group will, you know, miraculously find the startup you've invested in on their crystal ball and say, you know what, I'm going to exit here. We want to take a much more systematic approach and say, let's talk to the people who would potentially acquire these companies. Who are these? You know, whether they're the big digital players across the globe, are they the family groups who are very brick and mortar and want to get online? And we're already engaging with these people and saying, what would you buy if you would buy anything in digital? Now, you know, it may sound like we're trying to backward engineer it. Maybe we are. But it's not bad to have this conversation, because then you kind of see what's coming. So, you know, in a nutshell, there's still a lot of gaps, but there has been a lot of progress, as I said before. And of course, Dubai and UAE has come a very long way and is definitely a hub and a leader in the region. And it's not by chance that I personally am here, and we decided to base Iliad Partners here. Dubai is a hub, UAE is a hub. It's innovating, it's at the forefront. And now you have a situation where the best and brightest of the region are coming here. And I think this is not by chance. You have an ecosystem that's developing, and you have a lot of great benefits, which, you know, some of our partners and even the organizers of this week are pushing forward. So in this context, why is an investor pitch important? You know, zooming into our topic, it's important because, you know, first of all, it's your chance to get on your investors' radar, to get them interested in your startup. But given all that's happening, you know, your investors' time and attention is limited, so you need to be focused. But more, on top of everything, it's very competitive. So there are a lot of startups competing for scarce money. So this is your chance to really kind of stand out from the crowd. So in my experience, you know, you need to be very well prepared. You need to differentiate yourself, and eventually it can lead to funding your startup. You know, sometimes I get questions like, oh, you know, if I do a great investor pitch, does it mean I get the money tomorrow? No, it's the beginning of a process. Unfortunately or fortunately, not the end. So I'm just going to take you through some of the mechanics. what I plan to do actually is not to bore you with the details. I'll kind of go over the key themes, and then if you have any questions, I would much prefer to make this a discussion and talk about any questions you may have. And I'm more than happy to give you my insights from my own experience. So, preparing a pitch deck. The purpose of the pitch deck is not to be an exhaustive catalog of everything that your company has ever done. It's more about giving a brief, compelling overview of your idea and startup. It doesn't mean to answer all the possible questions about the startup. It's about to get people interested in potentially investing. So objective is to get them interested, open their minds to your vision, get them excited. So it's sort of like a hook to get them, want them to learn more things. So it's your chance to focus on showcasing the strength of your team, your product, your vision, and execute your plan. So these are sort of the 11, 12 key components. Most of you, I'm sure, know this very well, but I'll just sort of go through it very quickly in terms of what I've seen as sort of essential elements of a pitch deck. First of all, it's the elevator pitch. Something short, memorable, summary of your vision and value proposition, which very quickly, within 30 seconds, can get people interested in your company. Then, it's good to talk about the market. How big is the market? Is it growing? Who are your target customers? You want to be targeting a big market that's hopefully growing. Third, what's the problem and current solution? So what is the problem you're trying to solve? It's good to try to contextualize what you're doing. Say this is the problem, this is what we do, this is how we solve it. It definitely helps people relate, especially if you give examples, to relate to what you're doing. Product, what's your solution and the value proposition? Business model, sometimes people forget this. How do you actually make money from this? It's an important point. Now, it doesn't mean that money has to come in today, but you need to have a plan on how to get there. Strategy and go-to-market approach. So how will you reach the customer? How will you make people aware of what you're selling? How will you market and distribute your product or service? 7, momentum, traction, and expertise. This is also important. So if you've had some early wins, if you've raised some seed money, if you have a fantastic MVP / product, some milestones, some success stories, some awards, let people know. It's good to show that you've accomplished things, and it kind of gives you credibility, especially if it's not a very well-known startup. Team and key stakeholders. Who are the founders, the team, the advisors, investors, and board? This actually, at least from my perspective, is probably by far the most important thing. So if we were to look at any sort of startup, we would look at the team first. We believe products can pivot, markets can change, but the team is really the foundation of what you're investing in. So very, very important to show who's on the team. And many times I ask, how have you met each other? How have you worked together? It's important to show also how the team has come together. Is it people you know from a long time? Is it someone you just met a few days ago? The team is fundamental. And from there on, some other key elements, such as number 9, which is financial. So what's your 3 to 5 year financial plan, including the assumptions there? It's not important the numbers as the assumptions. Investors want to see that you've thought this through, and it's sort of a coherent and well put together business plan. Competition, of course. It's always easy to say, I actually don't have competition. There always is some competition, even if it's people's inertia or if it's some other product that is seemingly irrelevant. It's always good to think what is competing with you for people to adopt this product or service. And the punchline, which is, okay, given all this, the investment, what are you asking for? For example, I'm asking for $500,000 based on a $4 million valuation, etc. And what are you going to use this money for? It's important to put that. From there on, some optional things would include, what would be your exit strategy, some partnerships, maybe a product demo, existing clients. But I think these 11 are enough to sort of get started. By the way, feel free to interrupt me with any questions as I go through this. So, these are, please.
Typically, what's your attention span, time-wise, to deliver all this information?
That's a good question. I'll try to answer generally and then about myself. So, generally, investors unfortunately, are not people who have very long attention spans. So they won't read the details. I think what they do is they scan through things, they see some proxies which they like or don't like, and based on that, and depending on how the introduction came, which also actually is important. So, you know, and I'm being very transparent. It's different between, you know, someone from your board calls you and says, hey, I've seen this company, it's fantastic. You know, you've known this guy 10 years, you trust him blindly. Please take a look. Versus, you know, through the website, you know, I'm a, you know, XYZ type company, take a look. I'm not saying that you won't look at it, but I think it kind of ticks a few boxes. So I think what happens is people will kind of screen through it very quickly and see if there's some of key things that kind of resonate. And then if that happens, then they deep dive and look at it further. So also, like, think about like when you're hiring someone and you go through a CV. I don't think anyone like reads every single line. You may, but you kind of look through and look at the proxies. Cool. So just some quick stylistic, and these are personal. I mean, people can choose and how they want to do this. But in my view, compelling decks are, number one, they're brief and concise. They tell a story, very important. They're not just a bunch of facts like that sitting on a page. They tell a story. There's a narrative. They're visual, unlike this presentation. They have pictures and, you know, keep you engaged. They have numbers. They're accurate, and, you know, typically try not to keep it less than, you know, keep it around 10, 15 slides. I think that's a good number. So delivering a good pitch. So now you've developed the document. That's, you know, step number one. Now you have to present it. What are some of the things that I've seen work well? Number one, I don't think there's any substitute for being prepared. So practice, practice, practice. Know your facts. Read the presentation in front of the mirror. Your friends. I think it has to be a little of a second nature. I think definitely helps. Try to be clear, focused, and brief. You know, I think it's easy to kind of go on tangents or deep dive or get lost in details. I think keep the clear focus on the key messages, the key points you want to get through to your audience. As I said before, tell a story, tell your story. I think it makes it much more tangible and personable, and people can relate to that. You know, if you find something that you think can work, try with starting with a hook, something to get people's attention. Maybe that can work for you. Pace yourself, so don't go too quickly, don't go too slow. Try not to rush. Don't clutter the audience with too much information. I think another thing that's pretty cool is referencing things that people know and understand. So use analogies, use examples. It makes people better relate to what you're saying. If you can, try to create an emotional connection with your audience. Eye contact, posture, body language which is important. Use your deck as a reference point, not reading through a list like I am doing now. Be confident but not arrogant. Use humor. Stay within the time frame and a strong closing. So this is a bit of a laundry list of things that I've seen work. It doesn't mean that you have to do everything. It doesn't mean that everything is right. You have to, at the end of the day, you have to be yourself. That's the most important thing. Be yourself and use these things selectively as they work for you. So you're done with pitching. Now comes, I guess, the even harder part, which is managing investor questions. So a few tips here. Being prepared, again, is important. It's if they ask you something really fundamental about your business, it's kind of a turn-off if you have to kind of go through all these like pieces of paper and try to find things. I mean, obviously, if it's like a super detailed thing, like it's fine to go and find it. But generally, you should know the key facts about your business. I think it's important. Know your audience. So typically, questions are related to people's biases or investors' concerns, or to check if what you're pitching is actually within their scope. So if they ask you, where do you plan to expand beyond Dubai? They're asking because if their investment scope is GCC and you tell Morocco and Tunisia, it has, I'm not saying change your answer to fit what they say. Just be cognizant of why they're asking. So know your audience. Data is important and being specific. This needs to be clear, concise, and brief. Very important, answering the question that's being asked. Sometimes you see people answering other questions because that answer sounds better, but it's better to answer the question that's being asked. If you don't answer the question, there's nothing wrong with being honest and saying, you know what, I don't know the answer to this. I'll look it up and get back to you. I personally would much more appreciate that than someone that tries to fumble it or fake it and say, oh, it's this and that's actually wrong. I think there's nothing, you can't go wrong if you're honest. Say, I don't know this, I'll get back to you. Another thing is, if a weakness is identified with your company, which is, nine times out of 10, an investor will find something wrong with your company. There's nothing wrong with that, right? So it's it could be an opinion, which is an opinion, or it could be a valid point. If it's a valid point, it's okay to say, you know what, you're actually right, this is a weakness. However, this is what I would do to fix it, as opposed to being defensive and saying, no, this is nothing wrong with my company. It's the perfect company. It's the next Google. So if you don't want to invest in it, I think it's admitting the weakness. If it's a real weakness, is fine, and just say how you would address it and move on. I think that's sort of an interesting way to do it. Of course, be respectful and always try to close on a positive note. Even if you're answering a very negative question, it helps to say, you know what, you're right. We haven't been able to enter Saudi yet. It's a very tough market, but you know what? We're partnering with this Saudi company, and we've hired a country manager, and we're doing X, Y, Z, and hopefully in 2 quarters we'll be there. So I think it's always, not trying to fudge things, but at least try to close things on a positive note. So lastly, some common mistakes to avoid. Too much information. Sometimes we're so eager to talk about our company and idea, and we just drown people in it, in information. At the end of the day, whether it's this talk or a pitch you're attending or a pitch you're making, people will walk away with maybe 2 or 3 points. So always think, what are those 2 or 3 points you want people to walk away with, and try to make that resonate with them. I found this on the internet, so it's kind of cool. So follow Guy Kawasaki's 10-20-30 rule, which you might have heard, which is 10 slides, 20 minutes, 30-point font or greater. I don't know, it's good work. It's kind of a nice rule, it's catchy. In the first pitch deck, I would not have too much financial information or too much product information. I think enough to make people understand what is the product and what's the size of the opportunity, but I wouldn't drown them in too much of either of these. Obviously, wrong data will kill you, so try to be accurate, and having false or misleading information is obviously a red flag. I wouldn't belittle competitors, so even if the competition is very rough and they're playing dirty, I always take the higher moral road and not belittle them. You can always say why you think your company is better, but always do it in a respectful way. I would avoid false and silly assumptions that you can't back up. And I think personally I like people who are humble. I don't like people who are arrogant. We all work hard to get to where we are, so no one's better than anyone else. So I think arrogance is not a good thing. So these are some common mistakes to avoid. They're just a small list. It could be a lot of other things. So I would actually welcome at this point your questions, comments, things you want to talk about. I'm happy to talk about anything we covered or didn't cover. So please feel free to share your thoughts or questions. I actually prefer, and I think this will be hopefully the better part of this session. Please.
Hi, my name is Ben. I'm the founder of Convertible Note. I actually have a question for the audience. Who would be interested to see a real pitch from a company who's raising money and have the feedback from an investor live right now? Please put your hands up. What if I pitch you right now? What do you think? Shall we give them like a demo of how it looks?
Sure, okay. You're not putting me on the spot, it's okay. But that's very bold, I like it.
We're gonna show
Okay.
give you my pitch and...
This is not staged, by the way, he just did it. As long as I don't...
Okay, you can take questions the time I look
Okay,
at the
sure.
presentation.
So while I'm being put on the spot, if you have any questions you want to talk about.
Christos, yeah, I mean, you look at the investor deck, but what happened when, let's say, you have so Sébastien, founder of Iconic Shop, what happened when you start to get either the seed investors, or you catch the attention of the investors, and then you need to work on, to really make it up, real in terms of paperwork and in terms of really, legal contract and everything. So that's sometimes also one of the challenging situations is who are the right lawyers that can help you through this journey.
Yeah, actually, that's a great question. So, even in my experience, when I was pitching to raise for my startup in the past, so let's say you just dive into like trying to raise money and you don't have any investor materials. That's a very hard exercise, and you will get shut down. So we've done that. I've done it, and it's not fun. What is better is you come up with your pitch deck, you come up with your business plan in Excel, and you come up with some basic documents which you make the connection, and then you can share with the investor. And that shows being prepared, right? So like if you get interest from a VC and they're like, oh great, can you send me your investor deck, and it takes you 2 months to get back to them, obviously it's not a good thing. So I think that side of the preparation, and I've experienced this even in setting up my fund, is that we did a lot of the homework up front. So we kind of like tried to preempt what was going to be asked, and we're very quick to follow up. So I think that's one thing. The second thing is you definitely need a good law firm, good lawyer. As we all know, law firms and lawyers can be very expensive. So the question is, when do you involve them and how? And there's no right or wrong answer there, but I would say it would be a few things. I think it would be good to work with a lawyer who has worked with startups before and is a bit more forgiving and cost conscious and is flexible, right? So I think that's sort of important. The second thing is it's a risk also to involve lawyers too early, because then you like over-engineer the legal aspects of what you do, but also too late, right? So if you show up to a new lawyer and say, hey, look, I'm raising a round and I have a term sheet already, and he has no background, it can be tough. So I think there has to be a bit of a balance. If you're lucky, you may meet lawyers who are more entrepreneurial and are willing to maybe work for a little bit of equity, but I think that's a very rare occasion. I just think people should try to find lawyers who have done this type of work before and are they're willing to work around the parameters. It's very different to be the lawyer of like Microsoft or IBM versus a startup. Unfortunately, there's very few of these lawyers, but there are, and it's a lot of the incubator accelerators in Dubai and UAE can help people connect with the right people, which is great. So, are we pitching? Oh, sorry, please.
What if you're going into a Series A or Series B? So your company is already doing a turnover of say about 2 million annually. You've got 40% as your profits, and you want to go for external funding because you're going to a larger capacity. What are the other things that you have to add in your pitch then? Would it be the numbers then, your past traction? What would be the other add-ons? If it's for a right-of seed funding or angel funding, what if you're going for Series A or Series B?
Right, so to clarify, this is for Series A, but to your question, if it's a more mature company, I don't think it would fundamentally change the pitch deck. What it would change is a few things. Number one is the audience, so you would redirect who you're talking to funds that are larger ticket sizes. That's one. I think because later stage investors, or let's say growth stage VC investors, are more numbers driven versus team and idea driven, I think you would probably have to be more heavy on the numbers. And then also they may want a bit more info on the product and the IP as well. I think these are the three things.
Yeah, IP is becoming very sticky.
Exactly. No, that's a great question. Thank you.
Hi.
Please.
Can I just have a quick question?
Of course.
My name is Wayed Entoum. I'm the GM of a startup called Knowledge Way. If I can ask a layman question,
No such thing.
Here about early stage series A, B, C, etc. Could you just explain this to us very briefly?
It's a good question. I mean, actually, many of us don't even know that, including myself. So, first of all, okay, there are some general things that apply, but then things that differ across geographies. But to talk about MENA, seed is typically money you need to get started. You may or may not have a product, and you don't have revenues. Series A, you have a product, and you have some revenues. Series B is you have significant revenues, and that's up to evaluation, and you need the money to really scale. So this is roughly what it means. What it means in terms of money is very different across geographies, but typically seed money can be up to like 500K typically. This is typical, it's not averages. A Series A will be around maybe 1 or 2 million, and then Series B and above is 3, 4, 5 million. But I think what's important is not the money, it's the milestones, right? So if you're raising Series A, you should be at a point where you've validated the product, you've proven that people want to buy it, and you have some initial revenues. I think that's sort of the important thing for Series A. I hope I answered your question.
Yes, greatly. Although it can be a gray line.
Yeah, it's not strict. It's not strict.
Thank you.
Thanks.
Yeah, sorry, slight follow-up of his question. What if you've already, say your traction, like I said, you're doing 2 million, you're doing 40% revenues, and you're still going...
You have a specific example in mind?
Yes.
Okay.
I just want to know exactly what numbers are you looking for in terms of what what would be the IP ticket you'd give away. So if you're looking for only $1 million, what should be the IP you give away on a company that's worth about doing $2 million worth annually with 40% straight?
Yeah. Are you talking about the equity stake?
Equity stake.
Okay. I think that's a complicated question, and it depends on many things. But in general, as a benchmark, here and internationally, when an investor is looking to invest in a Series A company, Series B. Okay.
Series B, I'm already doing 2 million, 40% revenue.
Yeah, that really depends. I'll tell you, Series A, companies give away between 15 and 25. That's a healthy amount.
Right.
For Series B, it depends what happened on the Series A, so it's hard to tell. But I think to generalize the comment and kind of give some insight that may be helpful to you and others, you don't want to be giving away majority before Series B. And a lot of investors who may not know better ask for majority, which is actually not a good thing. Yeah.
I'm seeing that a lot of people just come and ask you for, and you're like, how are you doing this number anyway? So is there some format you follow or anything that you could look at?
Unfortunately, not format, but I think there's some general principles. So like if I was running a startup and raising a Series B round, I would not want to have less than 50% of the company. Maybe in Series D or whatever, but you need to save equity for yourself because you're the founder. And you also need to save equity for your employees. This is another thing that's wrong with the ecosystem, that you have startups which give salaries but not equity. This is a cardinal mistake. You need to give equity to people to be incentivized. And actually, if you're the founder and CEO of a startup and you're interviewing people, and they keep on pressing on salary, you may be talking to the wrong person. People should be, pushing for equity. I mean, they need to pay their rent, but they need to also be pushing for the equity. So.
Because otherwise you lose, by the time you get to your Series B or Series C, you've lost the entire team that you're banking on.
Yeah. No, and I'll be honest with this. I've seen some horror stories in the region where investors, especially if they're not really venture investors and they're pushing for gaining majority or huge equity stakes in startups, I think this is criminal because you kill the startup. You really do. Excellent. Should we do the pitch?
Yeah, sure.
Sorry. Should we do one?
I think there are 2 questions. Yeah.
We'll do 2 last questions, and then we'll do the live unexpected pitch. Hope I don't miss my flight.
Hi.
50 minutes.
I'm joking.
Quick question. You said once you've done the pitch and introduction, there's then a whole process that can generally take between 3 and 6 months. What are the basic steps on that between making a good pitch to signing a deal? What are and you can summarize them.
Of course.
What are you looking for afterwards?
Sure. That's a very good question. So I was surprised the first time I raised money. It takes a long time. So on average, you should count on 6 months, sometimes longer. So I've seen it go up to 12 months, even more. So raising money at the right time is important. Meaning what? If you're gonna be running out of money in 3 months, you're way behind schedule, right? So you want to be raising money maybe at the 6-month mark, and you still have another year ahead of you. So you kind of have to plan that out. From there on, there's the typical sort of, steps, including scanning what investment sources are out there, understanding people's investment scope and thesis and criteria. This is very important, because if you go knock on the wrong doors, you're bound to get no's, right? That's first. Second, you engage with them. I would typically recommend that people try through their network to find people they know. There must be a way, you know, whether this is through the VC's board of directors or people you know in common through LinkedIn, or, you know, it's much appreciated that someone put the extra effort and said, you know what, I will get in touch with Mr. XYZ because I know this other guy, my friend, you know. So getting a qualified lead or you know, sort of a warm introduction is very important. Then once you've established that, then you share the initial materials. It may take investors anywhere between days and a few months to get back to you, because they have a whole pipeline. You know, in order to give you a sense, in order to do 3 or 4 investments per year, you may have to look at 250 companies. So let's say immediately you eliminate half, but then still for this other half, you go through the companies in detail. You look at the financials. You know, it's a lot of work. So you have to accommodate for these steps. So just to finish off what you were asking, they'll get back to you. You'll have definitely 3, 4, 5, 6, 7 follow-up meetings. It's not a transactional thing. It's not like, okay, if you press the button, you get the funding. You get to know each other, because I think also the personal component is, you know, can you work? I mean, you essentially make the investor almost part of your team in a way. So you want to make sure you can work with that person. And then once all that happens, you go into this thing called due diligence, which is a scary process, and you deep dive, and there's a virtual data room, and they call everyone you know, and they go through your financials and etc. Once that's done and they're happy, which is now we're talking about 4 or 5 months down the line, they'll send you a term sheet, and then you have to sit down with your lawyer and look at it, make sure that they give you fair terms. And you know, one of the things we pride ourselves with Iliad Partners is that we want to be fair and balanced, and take the perspective in many ways of the entrepreneur. So we don't want to demolish the entrepreneur, because that defeats the purpose. So you have to look at the terms. So, you know, indicatively there, you have to look at things like liquidation preference. You know, when I first started this, I'm like, what the hell is this? It means that when the company is sold, how many times will the investors make their money back before you make any money? So, you know, it should be a 1x. If people, you know, unless...
15x now.
Sorry?
15x now.
That's...
Any good funding, anything.
No, that should be impossible, yeah. I mean...
It's scary.
Yeah, it's scary. It should be, in my view, should be 1x. In extraordinary case, maybe 1.5, 2, if there's like, you know, a very good reason. And unless you're like, you know, in Silicon Valley and working at Kleiner Perkins. So, you know, there's some important things to look at in the terms. And I actually think that would be a good session to have on, you know, what are good terms from the entrepreneur point of view when you're negotiating with VCs. Again, I've heard a lot of horror stories there. Anyway, so you do the term sheet, you agree, you sign, and then the due diligence wraps up after that, and then you go to what they call the long form documents. So you sign the contracts like subscription agreement, etc. All this, if you're very efficient, quick, and fast, it's 6 months.
We have a last question.
Sorry, yes.
Thank you. I'd like to know your opinion on the mix between debt, equity, leasing, so the variety of forms of funding, and whether taking debt aids the process of winning equity, where that kind of fit with things. I'd be interested in your take on, please.
Sure, that's a good question. So I don't think there's a right or wrong answer. Generally, startups and startup investors are a bit allergic to debt funding when it comes to startups, but there is a major exception to this, the thing called convertible note. The convertible note is basically you raise money in the form of debt, you don't agree on a valuation, you give a discount of about 15% to your investors who invest in you, and then in maybe a 6-month period, this converts into equity, and you also allow them to invest at a discount in the next round. So actually, this is a pretty standard way to do it, and if it's, you know, if it follows the basic principles of leading accelerators such as Y Combinator and others, that is it's a good way to do it. but I would not be a fan of startups taking on big debt outside of the scope of such arrangement, especially because there's still things to be resolved in the UAE, for example, such as bankruptcy laws and other things. If you're a startup and an entrepreneur, you don't want to have personal liability on things. So I would say, convertible note is good if it's done in the right way with the right people.
And if we're talking Series A?
Series A, I personally would recommend equity. A convertible debt is kind of a good thing to do when you're trying to bridge around. So if you're between like seed and Series A, or between Series A and Series B, I would do convertible debt. And the convertible debt, the main benefit is that you don't spend days, weeks, months debating what the valuation is. You say, we'll figure out that then after. We close quickly now, and I give you a 15% discount on the valuation, whatever that is, with a cap. So I think there's no right or wrong answer, but this is how I view it. Thanks for your questions.